Welcome, everyone, to today's presentation. I'm Brendan Hughes, Marketing Director at Equity Trust. We have an exciting topic to cover today. We're going to shed some light on an area of real estate investing that in the past hasn't gotten much attention, and when it does, oftentimes there are many misconceptions surrounding it. We'll be talking about private equity investing within real estate. In addition, we'll be reviewing how it's possible to use retirement accounts, such as IRAs and 401ks, to make those investments, and talk about the potential benefits that might provide. Really looking forward to diving in on this topic. As I mentioned, for many people, learning about any type of private equity investing can be a little intimidating. It can even seem like it's an investment that is shrouded in mystery, with seemingly complex rules and ideas around who can be eligible for these types of investments and how it works. Luckily, we have a great guest here today to provide more clarity to private equity investing, and in particular with regards to real estate opportunities. He'll provide insight for people new to this, giving an overview in simple terms. He'll also give some updates on the latest trends and how new technology is making access to private equity opportunities easier than ever. So there'll be also plenty of great information as well for people that are already familiar with this topic. And as I said, after that, we'll dive into how it's possible to use your retirement account, often referred to as a self-directed IRA, to make these investments. I'll touch on how some potential benefits for investors are possibly using the retirement account as a funding source for this investing, something you might not have thought of, and the possible tax advantages when using an IRA. We'll also give a simple overview of how it works and how to get started. At Equity Trust, we are a leading custodian of retirement accounts for both alternative and traditional investments, and we've been doing this for many years. So that is our agenda today. First, though, a disclaimer. Equity Trust as a passive custodian does not provide tax, legal, or investment advice. Any information communicated by Equity Trust is for educational purposes only and should not be construed as tax, legal, or investment advice. Whenever making an investment decision, please consult with your tax attorney and or financial professional. Also, this would be a good time if you have a pen and paper available, get it ready. You might want to jot down some notes or some questions you might have, as I'm sure those will come up during the presentation, and you can write them down, and we'll have ways for you to get answers to those questions a little bit later. I have a special offer for everyone attending today as well. A great resource for people that are interested in the self-directed IRAs. This is a book by Equity Trust founder, Richard Gesis. He's one of the pioneers of this industry, completing his first investment with a self-directed IRA in the early 80s. The book is titled Self-Directed IRAs, Building Retirement Wealth Through Alternative Investing, and is filled with education and more than 30 case studies on people using self-directed IRAs to build wealth for their retirement. So if you stick around to the end, I'll let you know how you can get a free digital copy of this book. You don't have to wait for the book if you don't want. If you have questions or interested in learning more about self-directed IRAs, you can request a free consultation from one of our senior account executives. They can speak to you about the different types of accounts available at Equity Trust and can answer any questions you have about the investing process. Call us at 888-382-4727. All right, I think I have done enough of the introductions. I think it's time for us to meet our guest. We are lucky to be joined today by Steve from Smartland. And, you know, I could give the introduction in the background, but I think it would be not fitting. And so I'll let Steve do that. Welcome today, Steve. How are you doing?
Hey, Brendan. Good. How are you? Thanks for having us today.
Great. Why don't you, as I mentioned, give us a quick background on who you are, your experience, your firm's experience, and what you guys have all been about.
Yeah, great. Thanks. So I'm the Executive Vice President of Sales at Smartland, and I've been here for nearly a decade now, and really excited. Love my job. Love Smartland. Great place. But my overall position is the responsibility and the strategic direction and performance of all of our sales teams within Smartland. We're a real estate investment company who specializes in single-family residential and multifamily housing throughout the Midwest. with a focus and concentration on the Northeast Ohio, as that is our hyper-local space that we've been operating in. However, we have been expanding our footprint, and we expect that that footprint will continue to grow as we roll out more of our equity offerings to a larger and a broader array of accredited investors and also non-accredited investors, and those are kind of deal-driven. But so I hold an MBA from Cleveland State's Monteahuja School of Business, as well as a master's degree in molecular biology, and I found myself in real estate about a decade ago, making a small acquisition, which in turn snowballed into a pretty large behemoth over the course of the last decade, and been sharing and educating on the subject matter now for several years, and we're really excited to share some of our knowledge today with your group at Equity Trust.
That's great. Great background in real estate and all types of aspects of the real estate investing. So today we're focused on the private equity aspect, and if you don't mind, I think, can you give us just like a quick 101 high level, what is private equity investing and in terms of real estate, so everybody has a baseline understanding of what we're talking about today?
Yeah, so it's still investing in an alternative real estate investment class. So it's using equity capital to participate in various syndicate groups, or new modern tech will lead you into possibly opportunities like crowdfunding. With the Jobs Act of 13, it really changed the landscape of how equity investing worked. Whereas before it was really more participation through a good old boy system. So if you didn't have the right network, or if you weren't plugged into the right network, you may have not had an opportunity as an accredited or a non-accredited investor in some cases to participate in equity investing in real estate. So being part of the overall ownership through the course of the real estate asset up until some sort of exit event. So that landscape has really significantly changed over the last few years. And what we were going to really want to highlight is the new tech that came with it, and how that's really opened up the landscape for new accredited investors to be able to participate and not necessarily have to be plugged into an existing network or be familiar with an existing network, but kind of do it from the luxury of their own homes or within their own private spaces. And it's just one click away now.
Great. Yeah, that is exciting. I know when that law first passed, there was a lot of questions about what that would mean for the market and how this might open up opportunities. Can you real quick touch on what's the difference between an accredited investor and a non-accredited investor?
Yeah, absolutely. So an accredited investor will have particular qualifications that the IRS has deemed, or the SEC has deemed, qualifiers, and more so deem them sophisticated investors. So you have to have a $250,000 annual income, and I believe it's $1 million or $1 million in hard assets without your primary residence. And then those qualifications change if you're married, or if you have a combined income, combined household income. So versus a non-accredited investor, most deals, equity deals today, they're limited to non-accredited investors unless it's a Reg A+. And we're going to save some of these technical terms maybe for another webinar. So I hope everybody kind of stays tuned, and we can dive a little bit deeper into that. But non-accredited investors clearly wouldn't qualify under those stipulations with the income qualifier or the asset-based qualifier, and more than likely wouldn't be able to access certain deal parameters. And those deal parameters are set forth by the SEC in an effort to protect investors and, for lack of a better term, grandpa and grandma from, let's say, sophisticated investment groups that offer sophisticated investment opportunities that are maybe more complex and have a whole plethora of legal elements that are associated with them. As with anything else, real estate investing, whether it's an equity investment or a non-equity investment, it still has inherent risk built into it. So those are really important elements to keep in mind as we discuss that.
Great. Yeah, that's great background again on getting us all kind of like on a baseline what we're going to be discussing. And I know you had mentioned briefly about, recently this has opened up some opportunities. The Jobs Act and some recent technology has opened up some different avenues or opportunities within this space. What are some of those trends you're seeing, and can you talk a little bit more about that?
Yeah, so actually with that change in 13, what we saw in the marketplace was it was really unique. What we saw was a large rollout of various crowdfunding platforms that allow, again, accredited investors and in some cases non-accredited investors to be able to participate in deals all across the country. And these deals would have been pre-vetted by the specific crowdfunding platform. And before 2013, what would occur is that you couldn't actually participate with an equity position. So you couldn't have any type of ownership stake in it. You could, let's say, fund it almost like a hard money lender, but you wouldn't necessarily be a participant or a sponsor of the deal. So it left you with limited accessibility or limited oversight. Whereas the crowdfunding, what it did, it opened up the entire country marketplace to investors in various long distance areas. So for example, like if you're in New York, you could find deals on various crowdfunding sites that are for California or for Seattle or for Miami. And the same vice versa goes if you're out of Seattle, you could find deals now that weren't necessarily in your hyper-local space. You could dive into deals that were in Miami or in New York, and then you could participate at a very low level. So it wasn't like kind of your classical higher level participations. In some cases, you could participate with as little as $1,000 or $5,000. So it opened up this huge opportunity for accredited and non-accredited investors to be able to see deals, investor grade deals or institutional investor grade deals that were vetted by various platforms. And then what we've seen since 13 and over the last 3 to 4 years is that not only has that space really blown up in regards to capital infused into it, but it's also changed drastically in how it operates. And what I mean by that is that many of the crowdfunding platforms that rolled out in 13, some have pivoted into different types of sectors or different types of specialties based on what they were able to gain through that insight from the Jobs Act. Some of them now just have become kind of multifamily lenders. In some case, some people offer still participation in various syndicate deals. However, most of them have really been able to water down, I guess, the product they're selling into more of a niche lending product. So in some cases, it's been really successful. But what's awesome about this whole 4-year run with this Jobs Act is actually what it bred for equity investing. And aside from, again, being access to a wide plethora of deals, easily access them from your couch or from your living room, from your home office or from your personal office or from your workspace, whatever it may be. But it also rolled out a lot of new tech. And that tech is what's really important. So and that's really what I think we want to highlight here today, is that from 13 to today, things that we're offering and some other syndicate groups are offering these days is that full transparent systems for their equity investors. And what I mean by that is that now investors can simply go to one of the sponsors' websites. They can see kind of the deal pages that are up. They can take the time, they can go through the legal, they can go through the private placement memorandums at their own will. There's much smaller participation levels, but it's the level of transparency and automation is the real beauty in what this tech has brought to the marketplace. So normally how it worked is that there was a syndicator who was raising an equity fund, and then that equity fund was supposed to perform X over X amount of time. And then you would get these kind of continual reports, and they would typically be like some sort of hand-driven report. What I mean by that is that somebody had to go in and do all this analog data entry. And to this day, a lot of that still exists in the marketplace, and that's what's really unique about some things that we're doing at Smartland, is that now all of our systems are automated. And that's what the tech has brought, automation within this equity investing space. So everything from the waterfall modeling to the distribution scheduling and distribution actual function, to K1 reporting, annual statements, quarterly statements, being able to access information about the property or the deal 24/7, have access 24/7 to your own dashboards. So that's been what's really cool about what the Jobs Act has done. It's really transformed the equity investing space, not only from eliminating kind of that good old boy club system, but it's also now eliminating a lot of analog processes that were old and riddled with fees that were ultimately passed down to the equity investors. So by streamlining a lot of these processes with this new tech, not only are investors still getting these institutional investor grade opportunities, but they're also not having to carry a lot of these additional costs along with the deals. So the deals are much more fruitful in that respect. The management fees are smaller on some of these deals from where they were classically, and it may not be huge dollars, but across millions and billions of dollars, you know, a quarter point or a half point is a very significant figure.
Yeah, that's great insight, and makes a lot of sense about how whenever there's a new opportunity in the marketplace, no matter the industry, once things begin and technology becomes more prevalent, it seems to speed up innovation. And it seems like this space is no different in that innovation has started to come fast. And with that, there's potential benefits and maybe some other things that investors need to be aware of. And maybe that's the next question is, as more of these platforms become more advanced, you know, what should investors be looking for when they're evaluating platforms or doing something in online? You know, if they're not in the good old boy network as they used to be, and they're more online, and these platforms are more functional, what should they be aware of? What should they avoid?
Okay, yeah, great question. So if it's just a third-party platform, for example, and that's just doing like a crowdfunding for equity, you're really putting a lot of faith and trust into the fact that that specific platform has an extremely well, how do I say it, well-built, is that proper English, that they have a well-built vetting system for the specific sponsors that are putting their deals out. So the flip side to that coin is that a lot of these platforms kind of want to ensure that they have high quality sponsors, because it also speaks to their potential longevity within the space, right? So if they're not producing well-vetted sponsors that are trustworthy or good operators, right? So it's going to kind of deter people from their platform if they perform poorly, or if the sponsors actually perform poorly. So it reflects back to kind of the character of the platform. So that part's really important. There's another piece where there's opportunities to work directly with the sponsor, so circumventing the platform. And in that case, you're really vetting the sponsor directly. So something like what Smartland has a platform for, where you could access directly to their deal pages, or our deal pages, I should say, in that respect. And what you're looking for there is that you're still going to need to do the same vetting, not only on the sponsor, but really most importantly on the deal, right? So you want to hit your parameters and your particular requirements, such as, you know, looking at what the projected hold time is, you know, what the projected returns look like. You want to take a look at the track record of the fund owner or the syndicator or the GP. And when I say GP, we mean general partner. It's just a little bit of legal jargon there for you. But you want to look at the detailed terms of the deal. And as always, the most important thing that you want to look at, right, are what are the risk point and parameters. So somebody who says, you know, there's no risk, it's probably a pretty risky deal, right?
Yeah.
But somebody who presents risk the proper way, and can kind of define those risk points, there's a lot of value, I think, to be had there. But then you're also looking for, if the deal is an owner-operator, as I mentioned, so if the deal is direct with sponsor and on the sponsors, if you're working direct with the sponsor, or if you're working through a broker, such as a third-party platform who's doing the crowdsourcing or crowdfunding on behalf of the sponsor. So you kind of still want to do all of those really important due diligence items. And then you're looking for, the hurdle schedules, the fee structures. Clearly, you're looking for fee structures that they're not being ballooned and that they're fair and they're within industry standards. And then, so you want to avoid those kind of unorthodox fee structures. And then you want to partner with somebody who's not, who has skin in the game ultimately, right? So reward is based on performance. And what I mean by that is that let's kind of drill down into that. So, you don't want to necessarily be engaging with a sponsor who has $0 in, relies on everybody else's equity, and then uses everybody else's equity to kind of take an equity position for themselves off a deferred, let's say, fee structure. So you want to have somebody that has skin in the game, just like before. You want to know what the risk parameters are. You want to know what the deal terms are. You still want to do the same due diligence, and even more so, right? Because with this new tech, it becomes more available to various sponsors or bad actors or just a larger group of people that this wasn't accessible to. So the same way, you still want to do your due diligence. You still want to be on top of your game, and you want to work with somebody who's reliable.
Yeah, that makes a lot of sense. And I know what you mentioned when you described the evaluation process and whether it was before this tech innovation has come and now post-tech innovation. There's a lot to evaluate and a lot to take in. And I know you mentioned something a little bit earlier about one of the benefits that the technology has grown even in the last couple of years is making that transparent, because as you just mentioned, there is a lot to evaluate. There are a lot of things to look for, and it would seem that the platforms that are able to provide the most transparency would benefit the investors, and that would be a benefit for investors moving forward.
No doubt. No doubt. And then most importantly, you want to have the ability for investors to have not necessarily easy liquidity, but also just simplicity of use. And whether it's they're looking to position themselves using, a tax vehicle such as a self-directed IRA with equity trust, or if it's they're looking to do it out of their cash account or a checking account, you still want to make sure that they're not opening themselves up to a vulnerable situation, and that all the right pieces and legal pieces are there in an effort to protect everybody's interest.
Mm-hmm. That's great. And then you mentioned a little bit about the self-directed IRAs, and I know I'm going to give a quick background in a few minutes, but what has been your experience with self-directed IRAs in this space or even other spaces?
So it's awesome. It's an awesome vehicle for investors to utilize. We've had great success for it. I know that not only myself, but many of my colleagues here at the office, they have a self-directed IRA. And kind of just to harp on the awesomeness of self-directed IRAs is that not what people really don't know, and that's the biggest issue, right? I think that we're presented with is that they don't know that they can use their self-directed IRA to buy an investment property or to participate in a real estate fund structure type deal or in an equity type of investment. They just don't know that. So part of our focus has been also on the education piece and letting our investors know, hey, by the way, did you know that you can? And we've seen huge success with it, not only on a personal level, but also from a business perspective. One, it opens up to a larger audience, and it opens up a lot of interesting opportunities for that audience. and especially for an audience that's not familiar with it. So many professionals really find it useful, and I think a lot of professionals like the idea that they can kind of command their destiny with their IRA. So I think that's a huge appeal, and that's what we've been kind of getting from a lot of our clients, is that they have an IRA, they have a substantial amount of capital in their IRA, they want to participate in real estate, and they just didn't know that they can use their SDIRA, or that they can, use a custodian for their IRA, make it a self-directed IRA, and position themselves into an equity deal with the funds that they have in their current, kind of standard conventional IRAs. So a lot of our clients are super excited when we either present that to them or advise them of that. They get typically pretty excited. And we've seen great success in that respect with the self-directed IRA. But what people don't know is that you can use your self-directed IRA to invest in a business that you don't run, for a full disclaimer. So one of the things about the self-directed IRA, just like your regular IRA, you have the ability to drive the decision. However, it still conforms to the same regulatory restrictions of access to the capital, right? So when we're marrying kind of our new tech with the self-directed IRA idea, what's really cool about it, why they go so well together, is that on the front end, our clients are able to present to us their custodian accounts. So we can kind of, in one bubble, we can complete all their compliance needs automatically now, do all their distributions directly to their managed accounts. So it's a complete pass-through. They don't have to participate. They never have their hands on it. And it conforms to all of the self-directed IRA compliance requirements to utilize when investing using your self-directed IRA. And that's what's really cool about it. And again, I think more than anything else, the SDIRA allows people the opportunity to, again, command kind of their own destiny and be a little bit more involved. So if, I'm not personally a stockbroker, I have a little bit of stock, but most of my personal is probably concentrated in real estate. That's simply what I'm in. So I'm much more comfortable with that. But I like to be able to command my decisions. So I can't make any decisions on Microsoft, but I can make decisions at, on my rentals, or I can make decisions and participate in a decision as a board member of a investment club through my self-directed IRA vehicle. So that's what's awesome.
Yeah, that's great. That's good to hear. And, as we kind of talk this through again, I want people to get, I know you or mentioned the Smartland and some of the tech that you guys have there. So I wanted to let people know that are on here today how they could maybe learn more about the tech that you guys have put together, and maybe learn more about private equity investing. What should they do?
Yeah, so great question. Really excited to answer this question. So we have a dedicated portal, which is equity.smartland.com. And clients could easily access that portal. I'm sorry, I have to rephrase that. It's equityfund.smartland.com. And it's an investment portal, and clients can access that. And it's got a really easy kind of 4-step process. It's really a 3-step process, but we call it a 4-step process. And you sign up on your own time. You just create an account. It takes maybe 30 seconds. You get self-verify if you're an accredited investor. You can immediately click on various investment opportunities. You could read the investment summary on the deal page, and then you could select an investment, and you could participate in that investment almost instantaneously. And then everything is automated, so it's a e-signature system. Everything is recorded. There's a document handling space. There's a dashboard space. And it's super, super easy. So it's super fast. It's equityfund.smartland.com. They can check us out. I think we'll include a link on how to invest in there. And And it's really designed, again, for simplicity, to open up to a broader range of individuals and give people the opportunity to really take their time, do their due diligence, by keeping it simple, safe, secure, and confidential. It allows the investor to be hands-off, and in the same time allows them to maximize their returns. And it's really exciting, and we're so excited to bring this new tech to the marketplace. We're one of the pioneering companies with this tech, so we're always really pumped to share with as many people as we can.
Yeah, that's great, and it's been great information today. So if people are interested in private equity investing in real estate and we want to learn more, as Steve said, you can go to that link on the screen there. And you know, we was talking, Steve, you were talking a little bit about the self-directed IRA portion, and so this would be a good chance for me to just quickly go through at a high level what a self-directed IRA is and how it works. And so what I'd like to do is have people look at the two images on the screen, the eggs. Now look closely at both, and can you tell what the difference is between them? I'll give everybody a second. All right. The answer is there is no difference. They're exactly the same. And that is true for an IRA and a self-directed IRA. Self-directed IRA is really just an industry term. All IRAs are the same rules, same benefits. One of the requirements for an IRA is that it must be held by a custodian. And the custodian can determine what investments it permits. So some custodians, most of the ones you've probably heard that deal with IRAs, permit mostly stocks, bonds, and mutual funds. But some custodians, such as Equity Trust, also will permit real property, private equity investments, promissory notes, precious metals, other things. And at Equity Trust, you can invest in both the more traditional investments, of course, but you know, over time we've focused on and have a lot of experience with the custody and administration of accounts that invest in things beyond the market. So on this slide, you can see some of those types of investments. As I said, Equity Trust, it is possible to invest in stocks and mutual funds and the assets listed on the screen. The tax advantages that are possible, assuming you follow rules from using the IRA, are the same, whether it's in the self-directed IRA or an IRA. Tax-deferred growth, passable tax deductions, any of those advantages are all the same. Just like the two eggs on the screen before, they're the same. So here's what I'll quickly mention, and Steve touched on this briefly, but there is the ability that people don't realize is the self-directed IRAs, the IRAs to become funding sources. So people might find opportunities, investment opportunities in the past, but didn't think they had enough cash or liquidity to complete the investment. What they might not realize is that if they have money in an IRA or an old 401k from a former job, or maybe they might know somebody that has an IRA or 401k that would like to invest with them. It's possible for all those sources to join together for the same investment. Or, as I said, if they didn't know that it was possible, it would be possible for their IRA to join in the investment. So once people discover this, they often start to think about those accounts, the IRAs, as funding sources. And in turn, it might help make some investments more achievable that might not have been in the past. The next thing you probably want to know is, how does it work? So keep in mind, every individual investment is unique and requirements can vary depending on a number of factors. But today we've been talking about private equity, so we'll talk in terms of private equity, and maybe I'll touch on how it would work with a real estate investment such as a rental property to give some context as well. But also want to note again that you should always consult with a financial professional before making any decision. And it's important to note that to make a self-directed IRA investment, you also have to have an account opened. So when I talk about this on this slide, we're just assuming that you have the account already open. And that might seem obvious, but I mention this because we've had people in the past that have been interested in this concept, identified investment, want to get started, but they didn't have the account opened. And especially in real estate investment circles, we've seen people miss out on investments because timing is so critical. So just for the purposes of this slide, we've assumed that you talked about any investment opportunities with a financial professional, you decided to move forward, and the account is open. So as we talked about before, you've done the due diligence, and then what you do is want to make clear that this equity trust doesn't participate in that due diligence part. We do not serve in a fiduciary capacity. The emphasis here is on the self-directed part of the IRA. Equity trusts here acts as on your direction. So you're the one identifying the investment and doing the due diligence. Once you find the investment, if it's a private equity offering, Equity Trust will purchase it per your direction. So Equity Trust has forms you fill out with relevant information to help us make the purchase on behalf of your IRA. And depending on the type of investment, there might be some other supporting documents that need to be submitted. It's important to remember that all the documents related to the investment are titled in the name of the IRA, not you personally. So here's an example of something that might seem small, titling, but is actually one of the biggest distinctions. The title of an asset is in the name of the IRA. You are separate from your IRA. The IRA owns the asset. So for example, if it was a single family home that you wanted to use as a rental, the property is owned by the IRA and rent checks are made out to the IRA, and anything that you purchased related to that property is from the IRA's account, not from you personally. So once you have the asset in your IRA, whether whatever it is, a stock, a real estate note, a private equity investment, a real property, when it's in the account, as you can see from the diagram on the screen, all profits earned from the investment must return to the IRA, and all expenses from the asset must be paid by the IRA. So as you see from the diagram, all expenses related flow out of the IRA into the investment, and then from the investment down back into the IRA account. It's important to note the middle part of the diagram. The funds that flow to and from the IRA are tax advantaged. So depending on the type of account, a traditional IRA or a Roth IRA, they have different tax treatments, but as long as the IRS rules and guidelines are followed, all of that assets and the account, the cash in the account are tax advantaged, which can help build wealth. And then what happens next while the investment is in the IRA is up to you and the type of investment. So what are the next steps? If there are terms to, let's say, a private equity investment, it will follow those terms. And when the investment is complete, all proceeds must return to the IRA. And then depending on the account type and if all rules are followed, it won't be taxed at that time. So this is the potential benefit of using a tax advantage account such as an IRA. The proceeds are not taxed while they stay in the account. You can then invest again and repeat the previous investment steps. And this is where you can start to imagine the power of using a self-directed IRA. In simple terms, let's say the private equity investment was $100,000. At the end of the term, you have $125,000. So $25,000 profit, it's not taxed while it's in the account, again, assuming all rules are followed. So now the account has $125,000 for another opportunity. And this is really the essential benefits or potential benefits of using a tax advantage account with any type of investment. And today we were talking about private equity, and you could kind of see how that could benefit you moving forward. So a real quick overview of what a self-directed IRA is and how it might help when investing in building wealth for the future. So I hope this overview was good. It provided some insight to self-directed IRAs and to private equity. If you have any additional questions about self-directed IRAs, again, you can call us at 888-382-4727. And as I mentioned at the start, I promised a free gift. So if you stuck around to the end, this is the end. So here it is, a free digital copy of Equity Trust founder Richard Gesis's book, Self-Directed IRAs, Building Wealth Through Alternative Investing. All you have to do is email the address on the screen, webinars@trustetc.com, put book in the subject line, and we'll send you out a link to that book as soon as we can. It's a great resource for anyone interested in self-directed IRAs. Thank you again to Steve and Smartland. Really appreciate you shedding some light on private equity investing and all the new tech and platform opportunities out there and what that means to investors interested in it.
Yeah, thank you so much, Brendan.
Great, great. All right, and that's it for today. I hope everybody has a great day, and we see you next time.